All right, welcome back, all you capitalist pigs. We are looking at Monday, the 20th of February, and today I'm going to run through just a couple of things. Now, I got one feedback last week about the charts that I'm using here, and the answer was I don't really like them. But I don't have, for those of you who don't know, just last week was a terrible week in terms of just common problems that happen anytime you're trading, and that was I had a computer that crashed on me. And the only other computer I had in my office was a Mac, and of course you can't get really decent charts on a Mac. I can still check positions and things like that, but as far as doing any major technical analysis, it presented me with somewhat of a problem. And so we got computer back up and running now, and I've got another backup on the way. So that's why, if you're wondering about syndicate members, why we didn't have anything last week, that was it. I was worried. I was trying to get computers back up and running and working on a couple of other things. So that went by the wayside, but we're back in action this week. So I'm going to continue to use this. So we'll get Ninja Trader charts back up and running for next week, and you guys will have that next week. But we're going to take a look at, we're starting with the euro here. Now the euro, remember last week, guys, I talked about the potential trend continuation trade after the market broke structure here. After the market breaks structure to the upside here. And then I said, stops need to go below here. Well, the market was really nice to us. We had if you were following the news at all last week, it was a nightmare. Greece had solved its problems, and then it was back in trouble. And then they thought it would resolved, and then it was back in trouble again. It was really just a really crummy week for the euro. And you see that reflected here, where we get a break of structure to the downside, and now we're back up again. And so we've really got no trade right now here in the euro. What we're waiting on now, if I consolidate this chart up, is we just want to see a break above structure again. So again, when this type of stuff happens, you take a look at this and you say, well, I get a break above, close above, I'm back in action again. And now I can take the same action that I took here, where the market broke structure, and then I looked to buy back in right in this area. Right in there. I looked to buy back in somewhere in there, and then that one got busted out on, but hey, we might have another opportunity. So if the market can break up, just fatten this up a little bit so everybody can see it, the general principle here still holds true. If the market breaks above and closes above and then pulls back into, it'll probably be somewhere in here, something like this, then we can look for buying opportunities. And again, we consolidate the chart up. One of the things you want to look for is, where's the market likely to go? Well, the next major hurdle is going to be here at around 135s. And then beyond that, really up here around 38s is going to be, really the next one that I'd concern myself with. You have some back and forth noise in there, but really the next leg of this journey is going to be somewhere around there, around 138.50s. So there is some room here to rally, and certainly some room for counter trade positions as well. I don't have any real ratio setups that I can look at here. Market has begun to break structure here, and now it's into some real congestion. Market's really trying to decide whether or not the euro is going to, what's going to happen with Greece and some of that type of stuff. And so you're seeing some real trading action happening here, which doesn't bode well for, longer term position style or longer term swing traders, which is what this forex market preview is really about. It's about longer term positions. But we carry on. Let's take a look at something else. Let's take a look at euro yen. This one I do like. Show you guys, we're breaking structure here, or at least we're trying to, right here. Trying to get over this hurdle. Market is going to make a determination here as to whether it continues higher above this zone or whether it rolls over. Now, interestingly enough, if I bring in my line tool here, we're going to see a harmonic move that exists. Right up to about where we are now. And we're into really a potential reversal zone between 105.40s and 106.70s. Now that's a pretty big reversal zone. The problem is they can't make it any smaller than that. If you look left, you're going to see support here and resistance. You're also going to see support here and resistance. And again, back here, a little bit more resistance. So we've got a potential reversal that could happen here on the euro yen. And we're back up against structure. And so, you know, it's one of those things with ABCD pattern completion, nice harmonic move there. We did not get a 382 retracement, so I cannot call this a... Oh, yes, we did. We did get a 382. So this is an official ABCD pattern. ABCD identified here. Just draw this in for you. ABCD pattern up into the area that we're in now. If the market will hold this area, you can look to short. Now, again, where do stops have to go? Well, stops have to go above this cycle top right here. And so keep an eye out on that as the market continues to rally here at where could the market go, and then make a decision. If the market will hold, and I'll give you one option for you here if you want to have tighter stops. And I do this sometimes. If the market will hold this line, and we can actually move this line a little bit because we want to make sure that it doesn't close above the highest high. So that's really where you don't want to get above. If the market will hold underneath this line, you can take the previous candle, and this is a trading strategy, so we're learning strategy here today. So let's say that where the market is right now is where the market closes. Boom. Well, you take this candle, the candle that's just recently closed, and you take the low, which would be around 105 even. You subtract 10 pips from it, and you look to enter if the market pulls back to 104.90. The other way that you can do it, and that would be on simply a stop. So you're going to stop yourself into the market as the market pulls back. It's going to trigger your entries, and you're going to get short. Another way to do it is wait for the market to close below this low. So this low again would be around 105. You would need to see a break below, close below the previous candle, and then you would take a short position. That's a way, guys, to protect yourself from just getting short on a limit and watching the market rally. You're going to wait for the market to give you some indication, some confirmation that it's going to go lower. Because look at what's happened during this entire rally. Have we ever closed below the previous low? No, no, no. All the way up here, we've never closed below. We've had spikes down, but we've yet to close below the previous low. If you wait for that break below, close below the previous low, it's going to give you a little extra in terms of when the market is likely to have a reversal. Now, so that's not always the case, but when you combine it with an ABCD pattern completion at structure, it gives you a lot more confidence that, hey, not only have I seen the market signal that it wants to go lower or it wants to reverse, but I'm also seeing that with the structure and with the harmonics that I'm accustomed to seeing. So by waiting for that, it just gives you that added confirmation. Now, the downside to that is that you get into a situation where the market breaks down like this, and we end up closing down here at 103. You just get a massive reversal. And then, of course, you're not in a position to take advantage because now your risk-reward is just redonkulous. So there are pros and cons to every trading decision, and this is what really frustrates a lot of new traders, is that they're trying to find the right way to do it. They're trying to find the way that they're supposed to do it. And while there are some hard and fast rules, like having a trading plan, making sure that your trading plan is profitable, that it produces a good return, there are many, many, many ways to enter and exit the market and to do it correctly. What you want to make sure of is whatever methodology you're using, you're being consistent with it, because it's that consistency that will ultimately lead to profitability. I've got a guitar teacher right now. I'll give you an example. I've got a guitar teacher, and every time I go into the guitar, I want to try and play it fast, like I'm Eddie Van Halen. And every time we come in there, when I start playing, he's like, "Well, that's way too fast." He's like, "You need to slow down. Let's take it." And it's like almost like half notes for my quarter note, for my for my regular notes. I don't even know that. I'm so green. I don't even know what it's called. But you basically take it at halftime when I'm learning how to do this, and it harps back to my days when I was shooting, when I was in the military, and I was in some very, I guess prestigious shooting programs. And they had an old saying, and it was slow is smooth and smooth is fast. So slow is fast, which is kind of it's tough to wrap your head around that until you realize that, hey, when you do it slowly and consistently, the same way each and every time, your body develops a natural comfort with that. And then you can speed it up and pick up your speed increases naturally as your muscle memory begins to form, doing that action again and again and again. Well, you can translate that into trading. And you could say, look, it's the consistency of doing something right again and again and again that leads to profitability. It is the consistency of following a plan day in and day out and doing the same action over and over and over again until it becomes second nature. And that's when profitability starts to rear its head. Because you've done it again and again, and sometimes you screw up. I remember, you had all kinds of problems when I was shooting with, causing the barrel of the rifle to come down, or the barrel of the pistol to go down, and it would throw off your shot, and so you had to go back in and you had to make adjustments and you had to really work on that little aspect of shooting. But eventually you got it, and eventually it got to where it was second nature. You knew what it felt like to do it correctly. Trading is the same way. Any skill set is the same way. You get to where you learn what it feels like to do it correctly. But that starts with having a plan, having a set of rules that you know are effective, and then beginning to engage the market every single day using that methodology. All right. Moving right along, I want to see if there's anything else in here. We've got kind of the same, we talked about in the pound, kind of the same situation. We've got a shelf back here of support, and now the market has run up against that. We've had what looks like a false breakout here. One of two options here. You can use the break above, close above, followed by the retracement, or you can look for a counter trend trade. I bring in my Fibonacci extension. Oops, that's not going to work. Bring in the Fibonacci extension. I'm going to invert the fib here. And you're going to look at a 1618 at around 161. Let's look left at 161. Oh yeah, look at that. Look at how beautiful that is. 161 coming in right with structure. Boom. Let's see if I got any more. So right up against that area, if the market rallies here, going to 161. And guys, that's a good, no matter what you end up doing, that's going to be a good target for you. So whether you're looking for a counter trend trade where you're going to look to get short around 160, or whether you're going to look for a trend continuation trade where the market breaks out here to the upside, then pulls back, and then rallies, that's where you're going. You're going to the 1618. Let's see here. Swissy were short with the Nooner trade, making some really nice profits off of that. So that's been a good trade for us, and we need to see the market break here. And guys, this is going to be an excellent, again, trend continuation trade if the market can get below this level. Because where are we going? Look at that. Potentially down all the way to 85s. 500 pip move? Yeah, it's absolutely possible, without a doubt. That's the next major turning point, is that cycle bottom there. So we get underneath this shelf, this market's going to just fall like a stone. All right. And again, perfect time to use that. Perfect. It'll be a perfect time to use that move. Wait for the market to break below, close below, look for a retracement back up into previous structure support. Sometimes that happens in the very next candle, guys, and that's the only entry that you get. You get the break below, close below, then in the next candle the market retraces back up, and then it just falls off. So you've got to, we'll look at it if it happens, and I'll show this to you again and again and again. But for beginners, guys who do not have a ton of ratio trading experience, this is just a really good, easy strategy for you to learn. And again, if we take the last leg of the move here, yeah, I'm looking, just doing some analysis. Okay. All right. Well, that's about. We're running 15 minutes here, guys. I'm going to go ahead and shut it down. Little lesson there on entries and exits, and on having a good trading plan. Anything else? No, that's it. I'm going to talk to you guys. I got nothing else for you. Until next time, guys. Good luck and good trading. I'll talk to you soon.